For those pursuing a dividend or an income investing strategy, a dividend cut is the worst thing that you can go through, especially for those investing for income and not growth. So in today's video, we're going to look at some of the most important factors in determining if a dividend is safe or if a cut might be in a company's future. But keep in mind that predicting a dividend cut is not an exact science. Things like corporate scandals or a tremendously bad quarter can occur, and as a result, a dividend cut can come out of nowhere. But in this video, we're going to look at some of the biggest red flags and the most obvious signs to look for if a dividend is in danger. So with that being said, let's go ahead and get started. First off, there's a really popular saying within the dividend investing realm, which is that the safest dividend is the one that was just raised. Generally speaking, this is usually true. It's pretty rare for a stock to raise its dividend one quarter and then immediately decrease it the next quarter. I have seen this happen before, but it's very rare because most companies know that this would make them look pretty bad. They know that dividend investors want stability in their stock distributions. If they're going to raise a dividend, they don't want investors to think they overestimated their outlook. It also sends the share price of a stock down whenever a dividend cut is announced, so it's usually avoided as much as possible by the company board. Likewise, it's usually the case that if a company has a history of cutting its dividend, then future dividend cuts are also more likely. Although it depends on the type of company, a dividend cut is usually a reflection of poor management by the board of directors. Unless a company replaced its board or they're making a strategic shift, if you see a long history of dividend cuts for a stock over the past decade, it's more likely that another cut will happen at some point. I can't think of any examples on the top of my head where a company suffered from dividend cuts over the last decade but miraculously improved and started increasing their dividends consistently afterwards. But like I mentioned, when it comes to looking at dividend safety, it depends on the type of company that you're looking at and what industry they're in. For the majority of dividend-paying stocks, including consumer staples, utilities, food, and retail companies, one of the most important metrics to look at is their payout ratio. The payout ratio shows the percentage of a company's earnings paid out as dividends to shareholders. You can calculate this by taking a company's dividend per share and dividing it by their earnings per share, but most financial websites will provide you with this metric so you don't have to do the math yourself. But this number doesn't really mean much if you don't know what's considered a good payout ratio and what's a bad payout ratio. There's also different opinions as to what a good payout ratio is, and it can vary greatly depending on what industry the company is operating in. Older companies that have steadier cash flows like Procter & Gamble, Colgate, and Clorox are going to have higher payout ratios than less mature companies like Apple. Again, opinions vary, but a payout ratio of under 50% is typically considered safe. Anything above 75% is considered to be higher risk for a dividend stock. There's also a couple things I like to look at in a company's financial statements that'll help me determine if a dividend might be at risk. For this, I'm going to use stockanalysis.com, which puts this data into a really nice looking chart. Looking at the income statement, if a company's revenue is flatlining or even declining, then that's a red flag, especially if the company keeps growing their dividend each year. Another thing I like to look at on their cash flow statement is their free cash flow. This is the amount of cash a company has left over after paying their operating expenses and maintaining its capital expenditures. Again, you'll want to look at the trend for the company that you're analyzing. If this number is going down quarter after quarter, then that's not a good sign that a dividend is going to be sustainable. Free cash flow is the money that the company has available to repay its creditors or pay dividends and interest to investors. If this amount keeps falling, then the company has less money available to pay dividends to their investors. These are some of the easiest things that investors can look at to determine how safe a stock's dividend will be going forward. Remember though, looking at these metrics should only apply to certain kinds of stocks. We're now going to take a look at equity REITs, which should be analyzed differently from consumer staple stocks and even differently from mortgage REITs because they're so different. What makes things hard for equity REITs is that there's no universal format that every REIT follows. Some REITs report their quarterly results in a different way than others, but the vast majority follow a similar pattern. With equity REITs, you don't use the traditional payout ratio that we looked at earlier. Because REITs own property and collect rent and they don't sell products or services, we need to use something else besides EPS when calculating what a company's payout ratio is. This is where funds from operation, or FFO, comes into play. FFO measures the cash that's generated by a REIT, which includes net income, depreciation, and gains or losses from asset sales for the quarter. Alternatively, some REITs will also report AFFO in addition to FFO. AFFO is considered more reliable than FFO when looking at the overall health of a REIT because AFFO also includes non-reoccurring items that might exist and maintenance capital expenditures on their properties. Unfortunately, most stock websites don't provide you with this metric, so you often have to calculate it yourself. But it's really easy. In order to calculate how comfortable a REIT's dividend is, we need to take the quarterly dividend declared and divide it by the FFO per share or the AFFO per share if that's what they reported. To give an example, let's look at WP Carey, ticker symbol WPC. Their most recent financial results were for the second quarter of the year. We can see that WPC declared a dividend of $1.69 per share. We can also see their AFFO per diluted share for the quarter was $1.36. If we divide 1.069 by 1.36, we can see as of last quarter, WPC had a payout ratio of 78.6%, which is very comfortable for this company. I should also mention that REITs are required to pay out 90% of their earnings back to shareholders in the form of dividends. So REITs often have very high payout ratios that are often between 70 and even close to 100%. We'll look at one more example. For Digital Realty Trust, ticker symbol DLR, this company declared a second quarterly dividend of $1.22 per share. They also reported in that quarter AFFO per diluted share of $1.59. If we divide the two numbers, we can see DLR has a payout ratio of 76.7% in the second quarter of this year, which again is very safe for this kind of company. Just like before, you'll also want to check a REIT's financial metrics for growth, or at least sustainability. Over on the income statement, you'll want to look at FFO or AFFO if they have it. If it keeps growing over time, then that's a good sign that the company will be able to keep growing their dividends. We're going to combine both mortgage REITs and business development companies because both companies report earnings in a very similar way. Mortgage REITs invest in real estate securities, whereas BDCs invest in small and medium-sized businesses. The way that most of these companies earn revenue is by collecting interest from their investments. Some of these companies make things easy by labeling in their results how much money they earn from their interests that are available for distribution, otherwise known as EAD. For example, with Annaly Capital, which is a mortgage REIT, their EAD in Q2 was 72 cents per average common share. In that same quarter, they paid a dividend of 65 cents per share, which gives Annaly Capital a payout ratio of 90.2%. In order to know the full health of a stock's dividend, you'll want to examine each stock's payout ratio over the past several quarters. If an equity REIT's payout ratio has grown from 87% to 89% to 93% and then 97% over the last 4 quarters, then that's a good sign that a dividend is in trouble and that a cut is likely to happen. In the case of Annaly Capital, although their dividend was fully covered last quarter, it doesn't paint the full picture of the company. You can see they've had a history of distribution cuts and falling EAD over time. So definitely don't analyze just one quarter, but look at their past earnings history. Also again, look at their dividend distribution history. If a stock has a long history of dividend cuts, it's a good sign that it can happen again. As we've seen in some cases, some companies will even report a payout ratio that exceeds 100% for a quarter or two, and yet they do not cut their dividend. That's because in some cases, the board might choose to keep the dividend if they believe conditions are going to rapidly improve, like if they had a one-off kind of event during a quarter, like a loss on a sale. Management teams know that a cut will send their stock share price falling and stain their company's reputation, so many try to avoid a dividend cut for as long as they possibly can. Instead, what a company might do is use the cash on their balance sheet to cover the dividend for the quarter. Looking at BDCs, they also report earnings in a very similar way. Taking a look at Blue Owl Capital, what we're looking for is net interest income per share, which in this case was 48 cents per share in their most recent quarter. This company also paid a special dividend in this quarter, so we're not going to include that for the sake of this example. Without the special dividend, this stock normally pays 33 cents per share in dividends. If we run the numbers, we can see that ticker OBDC had a payout ratio of 68.75%, which is really safe for this kind of company. Also, just like the other companies we've looked at, you want to look at their financial statements and check to make sure that the net interest income on their income statement for both MREITs and BDCs is at least being sustained or growing over time. Unfortunately, most stock websites don't display NII on the income statement correctly, so you might have to go to each individual stock's website. With closed-end funds, these can be much harder to predict because there's so many different types of closed-end funds that you can't look at the same numbers for each one. So instead, I'll give you 2 red flags that often lead to dividend cuts with these investments. The first is a long-term trend in decreasing net asset value. If you see a closed-end fund losing a lot of its NAV, that's usually a sign I see that a company's a future dividend cut. A second thing to look for is if the fund has been paying a lot of dividends that are being classified as return of capital. If the fund is paying a lot more of this type of dividend and it never used to previously, that's another good sign that there could be a dividend cut. You can find all this information by going on to cefconnect.com's website. In the end, just to reiterate, predicting dividend cuts is never an exact science. The only thing that we can do is look for warning signs that a cut might occur in the future. There's a lot of other things to look out for, but these are some of the most basic things to watch that can be applied to most investment types. But just because a stock cuts its dividend does not necessarily mean that it's the worst thing in the world. Sometimes companies cut their dividend in order to pay down debt or in some other way better themselves for future growth. So whenever a dividend cut does occur, you'll have to ask yourself if the cut is worth staying invested in. If you're just looking for income, then it might make sense to sell out of a holding, but other times, if you're willing to hold on, it could potentially lead to better future growth prospects for a company. But with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus, it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.